Hello viewers, today I'm going to talk about income tax rates for individuals. So what is income tax on individuals? When you are self-employed or sole trader, you pay tax as an individual. When you have partnership business, you distribute profit to the partners, you pay tax as an individual. When you form a company and you distribute profit to the shareholders, you pay tax as an individual. Likewise, if you work as an employee, you pay tax as an individual. By looking at this tax rate, some people might get confused. They might think if my income is $100,000, I got to pay 33% tax on $100,000, which is completely wrong. So how it works? Well, if your income is $100,000, for first $14,000, your tax rate would be 10.5%. From 14,000 to 48,000, which is 34,000, your tax rate would be 17.5%. And then from 48,000 to 70,000, which is 22,000, your tax rate would be 30%. And then the remaining 70,000 to 100,000, which is 30,000, your tax rate would be 33%. Then if you add up all the tax, your total tax would be 23,920. So that means you don't have to pay 33% tax on $100,000. If you have to pay only $23,920 if your income is $100,000. Over here we can see two different scenarios. Let's start with scenario 1. David is a full-time taxi driver. Even though he drives taxi full-time, still his net income is only $16,000. Why is that? One of the main reason is last year he bought an expensive car and he claimed large amount of depreciation expense. He got some other expenses to claim as well. And at the end, his net income is only $16,000. For first $14,000, his tax is 10.5%, and the remaining $2,000, his tax is 17.5%, and then his total tax is only $1,820. So David is a happy client. He is very happy with his tax accountant because he's not paying much tax. So there is no issue. So let's jump into scenario 2. In scenario 2, Adam is unhappy client. He's not very happy with his tax accountant. Why is that? Let's find out. Adam has full-time job. From his job, he earns $69,000, which is his main source of income. Suppose Adam drives Uber Eats. He didn't drive much. And he didn't buy a car in the last financial year as well. He bought a car a long time ago. Therefore, he can't claim much depreciation expense as well. Therefore, his gross income is not much and his net income is also not much, which is only $5,000. Out of $5,000, $1,000 will be under this threshold, 30%, and for $4,000, his tax rate would be 33%. And total, he got to pay $1,620. According to him, it's very high and he's not happy with his tax accountant. So what's the solution? Actually, there is no solution, and you can see his tax accountant actually didn't make any mistake. So he has to pay this much of tax. But good news is, through proper tax planning and forming different business entity, he can pay less tax in the future, but it depends on situation. Through proper tax planning, he can actually reduce his tax by 10 to 20%, but it depends on situation. Therefore, the solution is, if Adam wants to pay less tax in the future legally with proper compliance, he needs to get tax advice from professional tax accountant just like me. Thanks for watching.